Welcome back to the deep dive. Today we're plunging into a company that, well, it's really sparked some debate. Opendoor Technologies. Some see it as a tech titan, on the cusp of reinventing real estate.
While others view it as, well, financially fragile, struggling to find solid ground.
Exactly. The market's buzzing with excitement recently, the stock's flown up, but the big question for you, our listener, is that optimism truly justified by the underlying business? We're embarking on a deep dive into Opendoor Technologies, Inc. That's NASDAQ. Open. Our mission here is to dissect the available sources, pull out the most important nuggets of knowledge, really get some insight into this iBuyer pioneer.
And just for context, this analysis is current as of September 4, 2025. The share price we're referencing is $5.04, which is the closing price yesterday, September 3rd.
Perfect. Before we jump in, just a quick word about Stock Analytics AI, the platform bringing you these custom deep dives. If you're getting value from insights like these, please do like and subscribe. It really helps. For just $4.99 on a month, our members get priority deep dives on tickers. And actually, over the next few months, we're covering all of the S&P 500 stocks with exclusive member access.
If you just want a one-off deep dive on a specific stock you're interested in, you can simply drop us a super thanks.
Great. Okay, let's get into it. Part 1, Chapter 1. Business analysis. Okay, let's unpack this. Opendoor is known as the pioneer behind the iBuyer model. But what exactly does that mean for someone selling their home or, for an investor?
Right, so essentially, Opendoor tries to radically simplify selling your house. They buy homes directly from sellers, offering cash. Then they handle repairs, renovations, whatever's needed, and resell them.
And how do they make money doing that?
Historically, it's been two main ways. First, a service fee, usually around 5% of the sale price. That basically replaces the agent commissions you'd normally pay. And second, what they call the net spread. That's the profit or loss they make from actually flipping the home after factoring in all those renovation costs.
But here's where it gets interesting, right? They're not just sticking to that original model. It sounds like they're aggressively developing new revenue streams, ones that are less capital intensive.
That's a really crucial point. They're strategically evolving. They're pushing into ancillary services, things like title insurance and escrow through subsidiaries they own. They're also generating referral fees by expanding partnerships with traditional real estate agents.
So what are their key products now?
Well, you still got the flagship sell to Opendoor cash offer. That's their core value prop. Speed, certainty, convenience. Get an offer fast, close in maybe 14 days, skip the showings. But then there's Cash Plus, which they launched back in July 2025. This is more of a hybrid.
Hybrid, how so?
They give the homeowner a significant cash advance up front. Then Opendoor manages and pays for repairs, but a local agent sells the home on the open market. The homeowner then shares in any upside, any premium they get.
Ah, so Opendoor takes on less inventory risk that way.
Exactly. It reduces their direct exposure. And perhaps most critically, strategically, is their expanded Key Agent program. This is a platform for agents to integrate Opendoor's cash offer into their own toolkit. They earn their standard commission, plus an extra 1% from Opendoor.
Incentivizing agents to work with them, not against them.
Right. And top platinum agents even get high-intent seller referrals and exclusive listing opportunities from Opendoor. It's a big pivot towards collaboration. Now, looking at their market position, Opendoor is currently the undisputed market leader in iBuying. They operate in over 50 metropolitan areas across the U.S. They've served tens of thousands of customers since 2014 and sold, 4,299 homes just in Q2 of 2025.
So their leadership seems even more pronounced now, especially after some really big names bowed out of the iBuying game. What does that mean competitively?
Yeah, you're right. That's a key part of their recent story. Remember Zillow Offers? They shut that down in late 2021.
Big news at the time.
Huge. And Redfin followed with Redfin Now in 2022. These major exits basically cleared the field of direct, large-scale competitors for buying homes this way. It left Opendoor and the much, much smaller OfferPad as the primary dedicated iBuyers. So yes, it definitely concentrated the market, for a while at least. But at its core, Opendoor's main pitch, their value proposition, it still boils down to making home selling radically simpler. It's about speed cash offer in days, close in 2 weeks, certainty you get a guaranteed sale, a set price, and convenience, no showings, they handle repairs, you pick the timeline.
And this all sits within the broader prop tech industry, right, which is always seeing new things, e-signatures, fractional ownership. But how's the iBuyer segment itself doing?
Well, the iBuyer segment, which Opendoor really pioneered, it definitely boomed when interest rates were super low, no question. But it contracted dramatically in 2023. I think it was only about 0.5% of U.S. home sales then. mostly because rates shot up.
Okay, so that raises a big question, doesn't it? Can this model actually be resilient across different economic cycles, or is it more of a, fair weather friend?
That is the critical question for investors. But despite that slowdown, the potential long-term growth is still vast. I mean, the U.S. residential real estate market is something like $1.7 trillion annually. iBuyers are still less than 1% of that. Huge potential if they can crack the code. Now, direct competition. OfferPad is the main one, OPay.
How do they compare?
Key difference in approach, really. Opendoor, over 50 metros, typically that 5% fee, very tech-driven scale focus. They get good customer ratings, about 4.26. OfferPads in fewer markets, their fees are higher, more variable, maybe 6% to 10%. But they try to differentiate with personalized perks, like offering free local moves. Their rating's a bit lower, 3.92. So it's kind of scale versus personalization.
But the biggest competition isn't really OfferPad, is it?
No, not really. The real competition comes from the millions of traditional real estate agents out there, and also smaller local cash for homes investors. And what's interesting now, as we mentioned, Zillow and Redfin, who used to be direct competitors, are actually strategic partners. They integrate Opendoor's offer for referral fees.
So a shift from rivals to collaborators, in a way.
In some aspects, yes. Now, the regulatory environment. There aren't unique federal laws just for iBuying, but they are subject to FTC oversight. Advertising, marketing claims, that sort of thing. And this isn't just theoretical. Back in August 2022, Opendoor paid a pretty hefty $62 million settlement to the FTC.
What was that for?
Deceptive marketing. Basically, the FTC found they misled consumers into thinking they'd make more money selling to Opendoor than they would on the open market with a traditional agent. It's a crucial detail. Plus, you have state-level laws, disclosures, agent licensing that vary across all those 50-plus markets they're in. Adds complexity.
It's fascinating. Given the potential size of this market, why haven't more companies really scaled up in iBuying? What are the main hurdles?
Yeah, the barriers to entry are formidable. First, just immense capital. You need billions, literally billions, just for inventory. Opendoor's Q2 inventory was $1.5 billion.
Wow, okay.
Second, proprietary tech and data. You need a really sophisticated, accurate, automated valuation model and AVM. That takes years of data, serious data science expertise, constant refinement. You can't just build that overnight. And third, operational scale and logistics. Think about the infrastructure needed nationwide to inspect, renovate, maintain, and market thousands of properties simultaneously. It's a massive operational challenge.
So given those barriers, what exactly constitutes Opendoor's moat, their unique competitive edge?
Well, it's built on a few pillars, I'd say. They have strong brand strength and recognition as the iBuying pioneer. People know the name. They're also pursuing cost advantages, economies of scale, trying to lower per home costs by centralizing things, using their volume to get better rates from contractors. There's also a kind of two-sided indirect network effect. More sellers mean more inventory, which attracts more buyers, and more transactions mean richer data to refine their pricing models. It creates this self-reinforcing loop.
Makes sense.
But maybe their most crucial, unique asset is that proprietary home valuation technology. It's backed by a decade of data now, and they combine their AVM with input from local experts. Now let's talk about that strategic pivot you mentioned earlier, this shift to a capital-light, agent-led platform. It's a direct response to that brutal 2022 housing market downturn.
Right, things changed fast then.
Absolutely. The original iBuying model relied heavily on two things: low-cost debt and appreciating house prices. Both of those got completely undermined by the Fed's aggressive interest rate hikes. That led to, well, staggering losses for Opendoor. $1.4 billion in losses in 2022. Massive inventory write-downs. It was essentially an admission that the original model was just too fragile in a downturn.
But the exit of Zillow and Redfin, there's a bit of a paradox there too, isn't there?
There is, yeah. While it looked like a competitive win for Opendoor on the surface, they lost the benefit of those giants spending hundreds of millions on advertising, basically educating the public about iBuying. Now, Opendoor has to bear almost the full cost of market education alone. That could potentially increase their customer acquisition costs, maybe even slow down mainstream adoption of the whole iBuyer concept.
Okay, let's shift gears. Chapter 2, Management Evaluation. The ultimate test for Opendoor's management team really came during that chaotic 2022 housing market downturn. How did they actually handle that crisis?
Well, their response was sharp and decisive. Certainly painful for many involved. They went through multiple rounds of significant layoffs.
I remember hearing about those.
Yeah, 18% cut in November 2022, another 22% in April 2023, plus ongoing reductions. Adds up to over 40% of the workforce gone between late 22 and early 23. Financially, it was brutal. They booked a loss of nearly $1 billion in Q3 2022 alone, mostly driven by $573 million in inventory write-downs. Just staggering numbers.
And this period of intense pressure eventually led to a major leadership change, right? Was that just changing faces, or did it signal something deeper?
It seems like more than just shuffling deck chairs. The CEO, Kerry Wheeler, stepped down on August 15, 2025. That move was widely interpreted as a direct response to pretty vocal pressure from retail investors, especially after those tough years. And Trisha Radhakrishna, who was the Chief Technology and Product Officer, was appointed president and interim leader.
Interesting choice.
Yeah, it signals a strategic realignment, putting a real emphasis back on technology and product development as the core focus going forward. Now, in terms of communication and transparency, management is generally pretty candid in their public filings. They talk openly about challenges and the strategic shifts they're making.
Okay, but their ethical reputation, that's taken some significant hits, hasn't it?
Yes, significantly tarnished, unfortunately, by two major settlements we should highlight. First, that $62 million FTC settlement in 2022 for deceptive marketing practices, which we already mentioned, and then, more recently, a $39 million settlement in 2025 related to an investor lawsuit. That alleged they misled shareholders about the accuracy and capabilities of their home pricing algorithm.
Ouch. So two big hits.
Right. These incidents create what you might call a trust deficit, and they naturally could lead to heightened regulatory scrutiny down the road.
Let's talk capital allocation. Historically, most of their money went into buying houses, right? But that's obviously shifted with the pivot. How are they directing resources now?
Exactly. They're explicitly de-emphasizing inventory growth now, redirecting resources towards that agent partnership platform and the new capital-light products like Cash Plus. Their M&A strategy in the past focused on vertical integration, like buying OS National, a title and escrow company, back in 2019.
And they went public via SPAC.
Correct, in 2020. And worth noting, they've never paid a dividend. Given their current financial situation, no one expects them to start anytime soon.
Okay, but speaking of capital, in a move that might raise some eyebrows, Opendoor authorized a new $200 million share repurchase program just this past August, despite burning cash and projecting weak guidance. What's the thinking there?
Yeah, that is interesting timing. It appears to be a high conviction signal from management, suggesting they believe the stock is undervalued long term. It could also be aimed at support of the stock price, maybe appeasing that newly empowered retail investor base.
So less a traditional capital return, more a strategic message.
Seems that way. But it definitely comes at a time when cash preservation might seem more logical.
So pulling back a bit, how effectively have they actually been deploying their capital historically? What does their return on invested capital, the ROIC, look like?
Not good. Their ROIC is deeply negative, somewhere in the range of -8.14% to -8.79%. Now, you compare that to their weighted average cost of capital, their WACC, basically what it costs them to finance their assets through debt and equity, which is around 10.29%.
So cost of capital is over 10%, return is -9%.
Exactly. A negative ROIC that's well below your WACC is a classic sign that a company is, unfortunately, destroying shareholder value with its investments. That strategic pivot we keep talking about, it's a direct attempt to reverse this very, very concerning trend.
All right, let's dive into Chapter 3, financial analysis. What are the key metrics telling us? Their market cap is around $3.7 billion, roughly.
Right. Now, revenue growth, it's been incredibly volatile, tied directly to the ups and downs of the housing market, as you'd expect. They saw explosive growth from about $2.6 billion in 2020 up to a peak of over $15.5 billion in 2022.
Huge jump.
Massive.
Yeah.
But then a precipitous decline. Down 55% in 2023, another 26% in 2024. Q2 of this year showed modest 4% year-over-year growth, but their guidance for Q3 projects a sharp contraction again, down to $875 million. So a real roller coaster.
And profit margins. You mentioned the challenges. That seems to be the real Achilles heel here. How thin are we talking?
You're absolutely right to focus there. Gross margins are structurally thin, just 8.05% for the trailing 12 months, and that's actually compressed from 9.1% back in 2021. And operating and net margins, they've been consistently and deeply negative throughout their public history. Currently, operating margin is negative 3.80%, net profit margin negative 5.89%.
Wow.
Yeah. It just underscores how difficult it's been for them to cover operating costs and interest expenses, let alone turn an actual profit.
Okay, what about free cash flow generation? Is there any stability there?
Unfortunately, no. It's extremely volatile, and it's directly tied to how they manage their inventory. You saw a massive cash outflow of almost $5.8 billion in 2021 when they were buying heavily at the peak. Then you saw cash inflows in 2022 and 2023 as they liquidated that inventory, often, at a loss.
So it's not stable operating cash flow.
Not at all. It's really just the cash cycle of acquiring and selling assets. Highly susceptible to market swings, not a sign of a profitable core business.
Yeah. And looking at overall financial stability, they have a consistent record of net losses every single fiscal year since going public.
So no earnings consistency, only loss consistency.
Pretty much, yeah.
What about their debt-to-equity ratio? How leveraged are they?
It's high. Stood at 3.61 as of the end of Q2 2025. That's based on total liabilities of about $2.3 billion against total stockholders' equity of only $631 million. This high leverage is a direct consequence of that capital-intensive model relying heavily on debt to fund all that property inventory.
Okay, but their current ratio, measuring short-term assets versus liabilities, that looks quite robust on the surface, right? On the surface, yes. It's a healthy-looking 4.35. About $2.8 billion in current assets versus $643 million in current liabilities.
Seems strong.
It does. But here's where you need to dig a bit deeper. The single largest component of those current assets, it's $1.53 billion in real estate inventory. And the crucial insight here is that the true liquidity of that inventory is entirely dependent on the housing market conditions. As we saw vividly in 2022, that market can become illiquid very quickly.
Ah, I see. So the strong ratio might offer a misleading sense of security if they can't actually sell those houses easily.
Precisely. And just to reiterate, the company pays no dividend, no stability or growth there because there isn't one.
Right. Okay, let's talk valuation. Traditional price-to-earnings PE ratio.
Not applicable, NA, because earnings are negative. So instead, people often look at the price-to-sales or PS ratio. That's currently around 0.72. Market cap of $3.7 billion divided by trailing 12 months revenue of about $5.2 billion.
And what does that low PS tell you?
It reflects significant market skepticism about their ability to actually convert those sales into profit down the line.
Okay. For a more, let's say, intrinsic look at value, we could use a discounted cash flow, or DCF, model, estimating value based on future cash flows. How feasible is that for Opendoor?
It's highly challenging, mainly because of the unprofitability and all the uncertainty surrounding their future. But for educational purposes, if we build a model, we'd have to make some key assumptions.
Such as?
Well, probably negative revenue growth near term through late 2025, given their guidance. Then maybe gradual, modest, single-digit positive growth after that. We need to use a high discount rate, or WACC, maybe 10 to 13%, reflecting that high risk their beta is high, around 2.9, and they have substantial debt. And then a pretty conservative perpetual growth rate for the terminal value, maybe 2.0% to 2.5%.
Okay, so with those kinds of fairly cautious assumptions, what does an educational DCF model suggest for intrinsic value per share?
Using those inputs, this kind of model suggests an estimated intrinsic value range of roughly 75 cents to $2.25 per share.
75 cents to 225.
Right. And it's crucial to remember this valuation is highly sensitive to those assumptions we just made. But the significant gap between that fundamentally derived value range and the current market price of $5.04, that really underscores a profound disconnect. Part 2.
Okay, let's pivot now to Chapter 4, market sentiment. What are the professional Wall Street analysts saying about Opendoor these days?
Well, the consensus from Wall Street is overwhelmingly bearish, quite negative. Their average 12-month price target is hovering around $1.14 to $1.27. The range of individual targets is maybe 0.70 cents on the low end, up to $2.10 on the high end.
So well below the current price.
Significantly below. And the consensus rating is a firm reduce or sell. It reflects deep skepticism about the company's near-term prospects among the professional analyst community.
The general media tone, and certainly the stock's recent wild ride, seems to be telling a completely different story, doesn't it?
Absolutely. It's night and day. The dominant narrative in the media and online has been Opendoor's transformation into what many are calling a meme stock.
Right, that term again.
Yeah. It refers to stocks that see these rapid, often very volatile price surges, driven more by social media hype and retail investor enthusiasm rather than, traditional business fundamentals. Opendoor's recent surge, it was over 500% from its lows, is widely attributed to a classic short squeeze fueled by retail investors coordinating on platforms like Reddit.
And the CEO change played into that narrative.
It amplified it. That surprise CEO departure in August was seen by many retail investors as a direct result of their pressure. So the media tone really highlights this drama, this clash between fervent retail optimism and the company's, frankly, struggling fundamentals.
Let's look at some specific market indicators. Short interest, how much the stock is being bet against.
It's extremely high. As of mid-August 2025, about 24.16% of the public float was sold short.
Wow, nearly a quarter.
Yeah. That substantial bet against the stock is precisely the key ingredient you need for a short squeeze scenario if buying pressure comes in.
And how's the price sitting relative to its key moving averages?
Well, as of September 3rd, that $5.04 stock price is trading significantly above its 50-day moving average, which was somewhere between $2.11 and $4.71, and is well above its 200-day moving average, which was down around at $49 to $3.13.
And technically speaking, the 50-day moving average recently crossed above the 200-day. That created what's known as a golden cross, right?
That's right. Technical analysts generally view a golden cross as a strong, long-term bullish signal.
But there's a caveat here.
Big caveat. If you connect this to the bigger picture, this particular technical signal is a direct consequence of that non-fundamental retail-driven price surge. It really highlights the danger, especially for a stock like Opendoor, of relying solely on technical indicators when the underlying fundamentals are painting such a different and, frankly, more concerning picture. Technicals follow price, and the price here seems detached from fundamentals.
Okay, let's delve into Chapter 5, ownership structure. Who actually owns Opendoor shares? Who are the main stakeholders?
Institutional investors like mutual funds, pension funds, hedge funds, they own approximately 45% to 48% of the company. The largest positions have traditionally been held by major firms like Vanguard, T. Rowe Price, and BlackRock.
But there's been a significant and pretty telling rotation among these large holders recently, hasn't there?
Indeed, there has. Very telling. During the second quarter of 2025, we saw Vanguard dramatically reduce its position by 23%. That's nearly 20 million shares sold. And BlackRock cut its stake by a staggering 70%, selling almost 36 million shares.
Wow. Big names heading for the exits.
Right. This substantial selling by traditional, often long-term focused asset managers was met with aggressive buying from quantitative hedge funds. Firms like Quib, Weiss, Two Sigma. This indicates a clear shift in the ownership base away from investors focused on long-term fundamentals towards funds that specialize in momentum, volatility, and short-term trading strategies. It really underscores that meme stock dynamic we talked about.
Right.
Now, company insiders, executive directors, they own approximately 11.2% of the shares.
Has there been any notable insider activity lately, buying or selling?
Yes, a couple of interesting points. The newly appointed interim CEO, Srisha Radhakrishna, made a notable purchase, 30,000 shares, worth about $128,000 on August 28th.
A vote of confidence, perhaps?
Often seen that way, yes,
Yeah.
a crucial signal. However, that contrasts pretty sharply with a consistent pattern of selling by other key executives over the recent past, including the former CEO, Kerry Wheeler, who sold over 671,000 shares back in June 2025 before stepping down. So net insider activity over the past 12 months has actually been the sale of nearly 200,000 shares. Mixed signals from the inside.
Okay. And overall ownership concentration. Is anyone in control?
No, ownership is relatively dispersed. No single entity has a controlling interest. Vanguard is still the largest holder, but only at about 9.1% after that recent selling. A significant portion of the publicly traded float is held by retail investors. And this diffuse ownership, especially that large retail component, has absolutely been a key factor enabling the recent meme stock behavior and the high price volatility we've witnessed.
All right. Let's move into our Chapter 6, risk assessment. To get a structured view of Opendoor's strategic position, let's walk through a quick SWOT analysis. What are its core strengths?
Okay, strength, market leadership, and brand recognition in iBuying, definitely. Their proprietary tech, the AVM. They showed effective cost management during the downturn, cutting expenses sharply, and technically strong liquidity based on that high current ratio, although we discussed the caveat there.
Right. And the weaknesses.
Weaknesses are significant. Chronic unprofitability is number one. High leverage, lots of debt, clear cyclical vulnerability as proven in 2022, and that damaged reputation from the FTC and investor settlements.
Okay. Opportunities. Where's the potential upside?
Opportunities. That strategic pivot to the capital light model is the big one. The massive $1.7 trillion addressable market still offers huge potential if they can capture more share profitably. And of course, a potential future housing market recovery, lower interest rates, that would be a powerful catalyst for them.
And finally, the threats. What keeps them up at night?
Threats are substantial. Macroeconomic headwinds are huge, persistent high rates, the housing affordability crisis, intense competition, not just OfferPad, but millions of traditional agents and other tech players, ongoing regulatory risk, potential for more oversight, and things like tariffs and inflation, which could directly increase their renovation costs.
Let's drill down on those macro factors. How vulnerable is Opendoor specifically to big shifts like inflation and interest rates?
This is arguably their single greatest threat. Their model is exceptionally sensitive to this.
How so?
Well, think about it. High inflation tends to lead to higher interest rates from the Fed. Higher rates mean more expensive mortgages for home buyers. That suppresses housing demand, which means Opendoor likely holds its inventory longer, increasing its financing costs because they borrow money to hold those houses.
Okay, so demand side hit.
Right. But simultaneously, inflation in things like labor and building materials directly increases their renovation costs. That puts downward pressure on their already razor-thin gross margins.
Ah, so it hits them from both sides, revenue and costs.
Exactly. It creates this simultaneous attack on revenue, gross margin, and operating margin. It makes the business exceptionally fragile in the kind of economic climate we've seen recently.
What about specific geopolitical factors? You mentioned tariffs. Like the prospect of new U.S. imposed tariffs in 2025. How might that impact them?
Yeah, that's something they explicitly acknowledge as a risk factor in their SEC filings. Tariffs on key building materials, think Canadian timber, for example, would directly raise their renovation costs across potentially thousands of homes they process each year. That further compresses those gross margins we just talked about.
And potentially secondary effects, too.
Could be unpredictable secondary effects on pricing and supply dynamics in the broader resale market. It just adds another layer of uncertainty and potential cost pressure.
Okay, let's bring this all together now in Chapter 7, Conclusion. If we synthesize everything we've discussed, what's the most compelling bull case for Opendoor? Why might someone be optimistic?
The bull case really hinges on a narrative of technological disruption and massive long-term potential. Proponents see Opendoor not just as a house flipper, but as a technology platform. They believe its data and AI capabilities create a powerful, durable competitive advantage, a real moat. They believe the strategic pivot to that capital-light, agent-led model will successfully reduce balance sheet risk and, crucially, unlock a path to profitability. Plus, that vast multi-trillion-dollar U.S. housing market provides an enormous runway for growth. And of course, if the housing market recovers and rates come down, that would be a huge tailwind.
Okay, that's the optimistic view. Now, what's the bear case? The argument against its success?
The bear case is much more grounded in the financial history and the structural challenges we've talked about. Bears argue that the core iBuying concept, at least as Opendoor practiced it initially, has essentially been proven unprofitable and, importantly, not resilient through a full economic cycle. They point to the history of consistent cash burn and heavy debt. They emphasize the severe macroeconomic headwinds the company still faces: high rates, affordability issues. And they view the recent stock surge as largely an irrational meme stock bubble, completely disconnected from the fundamental reality of the business. That view is reinforced by the deeply negative analyst consensus and the pattern of insider selling. And just recap our valuation point. Our educational discounted to cash flow model, using those conservative assumptions given all the uncertainty, yielded an estimated intrinsic value range of just $0.75 to $2.25 per share.
So bringing it back to today, what does all this mean for you, the learner, the potential investor, looking at Opendoor Technologies right now?
Well, the current share price, around $5.04, stands in really stark contrast to that fundamentally derived intrinsic value range we just mentioned. The market at this price appears to be pricing in a scenario of near-perfect execution of the strategic pivot. It seems to expect a rapid, robust recovery in the housing market and a swift return to high-growth, profitable operations for Opendoor. Conversely, the company's actual historical financial performance, its current operational challenges, the macroeconomic environment, and the views of professional analysts all suggest a much more difficult, arduous, and uncertain path ahead. This significant chasm, this gap between the market's speculative valuation and the fundamentally derived value estimate, really represents the core tension here. It highlights the high-risk, high-reward profile of considering an investment in Opendoor Technologies at this particular moment in time.
So, as you reflect on Opendoor's journey, its struggles, its potential, maybe consider this question. In a world where technology promises to revolutionize almost everything, how much weight should a company's perceived potential carry when compared against its present-day financial realities and its actual historical performance? Something to think about. Wow, that was an incredibly insightful deep dive into Opendoor Technologies. Thank you. We hope this exploration gave all of you listening some valuable aha moments and maybe a clearer picture of the complex landscape surrounding this company.
It really is fascinating to see how these different perspectives, the bulls, the bears, the market, the fundamentals, all shape the investment story.
Absolutely. And if you found this deep dive valuable, please remember to like and subscribe to the Stock Analytics AI channel. It makes a difference. And remember, for just €4.99 a month, members get priority deep dives on tickers. We're actually covering all of the S&P 500 stocks over the next few months, and members get exclusive access to those.
Or if you just have one specific stock you'd love for us to tackle, you can drop us a super thanks.
Great. And just the quick but very important reminder, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice.
That's right. Always, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Until our next deep dive, stay curious.